Well, good afternoon, everyone, and welcome to our webinar today on COVID-19 business valuations and family law. I'm Peter Haley, a director in the Forensic Services Division at Vincents, and hopefully John Thynne has logged in remotely, who's also joining us. So you might have heard, as Donald Trump said recently, COVID, we're all sick of COVID potentially. And that's what today is about and how it's affecting valuations. Just a bit of how it'll work is we'll just set the scene for a few slides, have some general discussion, and then if anyone has any questions, if they could use their chat function to type in a question, and we'll do our best to answer that. So in Queensland in particular, and Australia generally now, I think most people, COVID has not had the effect it had in many places overseas, but just to give that some sort of perspective, that's a history of cases through to last week in Australia in terms of COVID in Australia. And you can see we've had periods where we've had virtually no cases, first wave, second wave, which is nothing really compared to the United States, where they had a first wave, never really got under control, had a second wave, not under control again, and now they're in the middle of a third wave. And the UK is currently seeing an uptick as well. This is the number of new cases reported daily. So as of today, what's happened? We did a similar webinar back in April, probably about 6 months ago, where the All Ords had dropped to 4,500. It's now back up to 6,147, which is essentially pretty close to where it was before COVID hit back in February, March. Interest rates are steady. They can't really go any lower. Stimulus packages are out there and sort of bolstering things. The big thing we've still got at the moment, obviously, is our border restrictions and international travel restrictions, which we'll come to in a second in terms of affecting certain businesses. The exchange rate, the Aussie dollar's back to 70 cents US. It had dropped substantially for that. Unemployment currently 6.9, predicted to get into double figures potentially in the new year. And Australia is actually in recession at the moment. And what's our outlook post-stimulus? So the federal budget was handed down recently, talking about the economy in general. The Treasurer, Josh Frydenberg, said, we're going to have a budget deficit of 213 billion, falling to 66 billion. Overall debt will be up by $1 trillion in 2024. There's a government debt. And their economic recovery plan is all about jobs, which is probably not much different to what you hear politicians speaking all the time. And that's by way of introduction to a new job maker hiring credit scheme, boosted business investment, further in refinement of the proposed changes to R&D, research and development incentives, fringe benefits tax and capital gains tax, and individual tax cuts being brought forward 2 years.
Hello, Peter.
John. So I'll hand over to John now just to talk a little bit about market value. And as I said, if anyone's got any questions, feel free to start typing anytime you want, and we'll get to them shortly.
So Peter just talked about the really the environment we're living within, which is obviously COVID. What we're trying to actually now do is overlay how does that actually work from our business valuations. And business valuations since March this year have been, in a lot of cases, quite challenging. We've had to be quite, creative how we actually apply the concepts. The primary concept we're applying in every single case is market value is the amount a prudent investor is prepared to pay in order to receive the future expected earnings, given the risk associated with those earnings. So it's all about the future. It's all about what we believe the business can do today into the future, given the risk of what's there. And obviously, the biggest risk we're actually having over and above what we normally have with business is the impact of COVID not only now and then over this immediate COVID period, but how is it going to affect it moving forward with the other factors that are actually coming in with our economy.
And I might just say that that definition hasn't changed as a result of COVID. That has been the aim I've been doing, and John has for 20 years. We've been doing valuations, and that's the definition we've used always. So it's always been about the future. It's just, I suppose, what today's talking about is how do you build in the extra uncertainty as a result of COVID?
What we're actually seeing in a lot of instances is that COVID essentially is forming a business interruption. The business was trading as it would normally trade up until February, and in a lot of cases March. We see the effect kicking in, not always negative, but we see the effect kicking in from April. We sort of started coming out of it in June, July, depending on the business you're looking at, and have moved forward since then. Some businesses are still heavily affected, particularly with border closures. Other businesses are not heavily affected, and some businesses actually went up, and we saw that with, obviously food, supermarket type outlets. Next slide, Peter.
Sorry.
So when looking at the majority of the business valuations that we do, we come up with this capitalisation of future maintainable earnings, which is a multiple of profits. But in coming up with our profits, what are our profits moving forward, particularly when in the short term we're having such a great change in actual performance. We've also got other factors coming in with all of the stimulus that was there. We've got changes in our employees, what the hours they were working. We've got JobKeeper, we've got cash flow boost, we've got rent assistance coming through with liabilities essentially less being paid now, but there's going to be some level of deferred amount moving forward. So can we apply a capitalisation of earnings? Discounted cash flow, theoretically the best approach to actually use, because it does exactly what our definition talks about, in that it actually is saying what are our future cash flows, what's the risk surrounding those cash flows. If we can quantify what the effect is, we put it in the earnings. If we can't quantify it, it goes to the risk. And that's really where we're sort of trying to get that juggle now. In a lot of these businesses where they didn't have goodwill beforehand, they're not going to have necessarily goodwill now. So we start looking at the underlying assets. But potentially we still need to look at if they're actually creating losses over the short term, you've got to fund those losses. Those business owners actually are there, need to actually inject funds just to keep the business afloat. If the business does have a level of goodwill, then we need to consider how we're going to address that. We need to address how it was trading beforehand, how it's going to be trading through this period, and how it's going to be trading and beyond. Our big problem is we don't have a crystal ball. We're, along with everyone, putting our best guess forward. We also have limitations as chartered accountants, or if CPAs covered by the same limitations, and we need to actually state what type of engagement it is. If it's a normal engagement and we can actually have whatever information we need, and we can utilise whatever resources and processes we need, we have a normal valuation engagement. That's where the valuations were prior to COVID. However, where there's something that is significant in nature that is preventing us coming up with or applying the process we'd like to actually apply, or there's something that is just unknown, we have to do what's called limited scope engagement or indicative type approach, which is really that we're putting our best foot forward, but there's things actually preventing us actually saying this is definitive what we believe the answer is.
And I think one of the big things that limits our scope at the moment, isn't it, John, is that often in a family law context, we're instructed, you can't actually talk to the parties, everything must be in writing. And one of the things in a valuation, a site visit or at least a telephone discussion with the owner, it's a lot easier verbal communication to get information than necessarily just putting questions and getting written answers back. And you just pick up the feel or the vibe of the business a bit through those conversations. And sometimes as a result of not having the conversation, well, it's almost, you don't know what you don't know. You don't know that as a result of not having the conversation, does that really limit your scope? Well, you're not too sure because you don't know what the owner might or might not have told you.
It's interesting, during this whole period, we've actually found parties, despite how they're getting on personally, they've been a little bit more of a collaborative approach in actually trying to actually how do we put something together to allow the matters to move forward. That's about as much where we want to actually get to now. We've got a couple of examples we might go through a bit later, but for now, are there any questions? So this is a forum, so please raise any questions you may have.
I suppose one thing I wanted to add, which wasn't on a slide there, in terms of how are we doing valuations differently, just from a procedural point of view. I think we're probably doing more analysis of potentially looking at, sales or even a profit and loss on a month-by-month basis, and say comparing April 2020 to April 2019 and seeing if there's been any major effect. And just looking at the industry in which the business is, just from our general knowledge of, certainly, as I mentioned earlier, some businesses, if you're in tourism or anything tourism related as a result of border closures and things like that, that's their industries in particular in Queensland that have been affected. Other ones that were affected for some time were, interestingly, dentists. They were pretty well forced to shut down for a month or so. So I'm in the middle of a valuation at the moment of a dental supply business. Well, March and April, their sales were terrible. But since then, they're doing about 50% greater because they're selling a lot more personal protective equipment and otherwise business as usual with their normal, drills and bits and bobs that they provide to dentists. But I suppose that's the main thing, that we're probably just doing a bit more analysis in terms of trying to work out whether the business in question has been affected in particular due to COVID, and just asking questions around that. As I said, whether it's verbally or whether in writing. The other thing you've got to watch as well is, what's the effect of the stimulus packages on the businesses, and those businesses that have been affected. As John mentioned earlier, if they potentially are looking at 6-12 months of loss making until things get back to normal, can they actually, will they be there and come out the other side? That's the other question we seem to be asking ourselves a bit more.
Which leads into a lot of what we have actually needed to do with a lot of these businesses, is to actually look at forecasting. So regardless of the actual methodology that we're employing, whether it be a multiple of profits, whether it be discounted cash flow, which often is the case, we need to actually look at how has the business traded through COVID, what's the effect been on the business, and as Peter just said, quite often, or a lot of instances, we actually saw, particularly in the short term, a positive influence, because although the sales were well down, and therefore profit from the core activities were well down, they've actually had a reduction in employees, potentially deferral of rent, deferral of loan repayments, with a cash flow boost come on board, which anything from sort of $20,000 to $100,000 plus JobKeeper. So a lot of businesses we looked at, although they've had 30-40% reduction in sales, they've actually got more cash flow during that time. So not necessarily moved backwards. The big thing is actually moving from this point forward with reductions in stimulus. How's the business going to recover? How much has it recovered, and how much will it recover? It was interesting, sort of coming out of COVID, we saw that July was, in a lot of instances where the business has been shut down or heavily reduced, July, people came out and spent. They came out of lockdown and they spent, they got out, they used venues. We saw sales in a lot of instances climb quite dramatically in July. They were still higher in August, lower than July, but higher in August, and then coming back to sort of bit more normality in September. So they've actually had a boost as a result of people coming out of that lockdown.
I have actually got anyone with a question, don't forget, put it in the chat. There's no stupid questions, so please ask anything you think. I've got the chat set up as private, so no one else will see your question if you think it's silly. I have got one here about, what about the long-term effects of valuations? And yeah, sure, that's something else we need to take into account is, will this business, it's managed to come through COVID okay, and it's back trading similar to what it was prior, but potentially, you need to look at, have they managed to, as a result of having people working remotely, will their rent in future, they won't need as much floor space to house all their people. Potentially they might have lower rent going forward when they can renegotiate their lease, and things like that need to be taken into account. How is restructuring the business and how they do business, how is that going to affect the profitability into the future? Just while we're waiting for any other questions to come through, there's a couple of examples here which are matters that John's done recently, so I'll hand over to him for example one.
The first one was an interesting one, and one of the reasons interesting, we actually had a double go at actually valuing it because time elapsed and we got to revisit some things while some financial statements were prepared. But it was an electrical business, electrician installer of fast food equipment into fast food chains. And what was interesting coming into COVID with the lockdown of restaurants, much of their clients they've reduced heavily what they were actually doing. So, we had food courts that were closed. We had a lot of restaurant chains that were, the restaurant side was shut down, but the drive-throughs kept going. So for differing levels with their client base, they had reductions in sales. We saw pretty much straight away any sort of preventative maintenance was put on hold, and new installations were all stopped. So the business went down dramatically. In April, we started the forecasting process. We actually were able to put through, given the seasonality of the business and where we're talking to the clients, the clients, we put in a forecast for the next 6 months, and it was actually predicted by the end of September. By then, we thought that's when things were coming out of the stimulus side. It would be pretty much back up to speed. So we actually did a forecast with a gradient sort of building back in when staff coming on board, when sales were increasing with borders reopening and sort of that staged release from the actual lockdown. And we're pretty happy with where it was. And interesting, we valued it prior to COVID, as in we valued it in April, May, prior to the effects of COVID. And the aim there was to say that's what it would be before COVID. That's where we expect it's going to be after the COVID period. What we need to actually do is try to forecast what the reduction in the trading performance would be, and therefore cash flow, over the COVID period. So we did our forecasting with what was there. And actually what actually turned it out, which was interesting, was with all of the stimulus that was involved, it actually was going to be in a better cash flow position by the end of September. Once we factored all that relief and stimulus in place. So we ended up in that case there, valuing it at the pre-COVID level, because the cash flow was actually going to be better as a result of what was being put in place. We had, with a couple of other entities, we had some financials done, so we had a cause to revalue it, reassess it in September. And what we saw was that everything came back a lot faster than what was predicted. So a lot of that deferred expenditure that was in place for April, May and June, as soon as everything reopened, it was almost like pent-up spending. Those businesses actually overspent in July and August. So the actual forecasts was smashed out of the water, to the point where they didn't actually do, from a core trading, that much worse than what they'd expect. However, they had the stimulus on top, so they're actually coming out of it in a better position than they actually went into it.
I've got a good question here. It's just come in. How do you untangle a business that is doing poorly due to the business owner being in family law litigation by design, as opposed to such things as COVID? As a family lawyer, I hear a lot of business owners crying poor, but who miraculously recover after settlement. I suppose there's nothing new there. That it just, I suppose we're often faced with that sort of circumstance. Businesses, and it might be by design, or it might just be that the business owner's eye is off the ball because they've spent a year, 2 years, whatever, with other things on their mind in terms of their family law settlement. So, but that's a good question. It's a matter of drilling down into the numbers. As I said before, if the business owner says, oh, it's all due to COVID, but if you see sales starting to fall off, back in September last year rather than March this year, well, that would seem to suggest that it's not a COVID effect, that something else took place maybe before that. And maybe it was, as I said, it's the business owner concentrating on trying to get custody arrangements in place, and their mind, just not being on the ball. I don't know if you had anything more to add on that, John?
Look, I do, and it's something that's been developed over the last couple of years with the, we now more often than not have access to the accounting data file. And the beauty of the accounting data file, which is all information we need to be able to untangle what we're doing. But the accounting data file allows us to do a fair amount of analysis in what's going on. And that analysis includes looking at the monthly trends. So what actually are the monthly sales and trading performance? What are the monthly expenses, the margins being achieved? How much are people being paid over time when new employees come on board, what differences are there. But also, very importantly, looking at individual clients. So if they've got ongoing clients, what are the sales of those individual clients? Are they increasing, are they decreasing? How much of the story we're being told marries up to the accounting data we're being provided? So a lot of it comes down to experience and gut feel, by we're actually taking all of the information we're getting and overlaying that with the story to see, is there anything that's not adding up?
And that's what I said before. It's that's why we just find, from a practical point of view, in terms of doing evaluation, being able to talk to people, and ideally going out and actually visiting the business and seeing it. And the other thing that's helped there is, as John said, the accounting data file. The movement of a lot of these to the cloud-based system allows us, we can just log in from the office. You don't need to take a backup. You don't need to do anything like that. The clients can give us a read-only access to the file, knowing we're not going to go in and change anything. But as John said, it just allows us to, you can run reports till the cows come home of sales by month, sales by customers, purchases. That's the other thing. A lot of people concentrate on sales, but a lot of businesses, maybe the major risk is they've got one major supplier. And we did see that with a fair few businesses that, they just couldn't get stock for a few months. Car dealers, for example, they couldn't get stock for a few months. Things just dried up.
Yeah, that's a good point.
The next one is, we might just give one more example.
Yeah, and we've got heaps of these examples because there's more and more coming through, particularly now that we're sort of coming out hopefully the other end of COVID. We're sort of seeing the effects starting to get minimalised. And so the financial statements are already taking into account the effect of COVID, whereas only getting a slight reduction in sales moving forward. This one was interesting. It was an entertainment venue that started COVID. They actually had planned for a slight renovation, which they proceeded to do, and they were about to do the reopening, and everything shut down. So a period of 3 months that they just went, all right, well, let's do this properly. And during that period from April to June, they renovated the venue, and actually took several new floors. So actually went from 1 floor to 2.5 floors. When everything reopened in July, this business exceeded any prior month sales. July exceeded by 3 times. It came out of the blocks absolutely firing.
I think, which was in part helped by the fact their major competitor around the corner had decided to renovate as well, hadn't they? So they opened a monopoly for a couple of months.
Yeah. It was the pent up, keenness to actually get out there and see this type of venue. It was around the corner. It was a whole range of things. August was lower, and September was lower again, but tends to plateau about September. October has been about the same as September. But we're seeing sales far in excess of what was there previously. And what we've been able to do is put together forecasts for this venue based on seasonality previously, based on capacity of the venue, based on ongoing COVID effects and how they're going to change their business. And so it's been quite an extensive process putting these forecasts together. But what we've ended up coming up with is a business that is very different to prior to COVID. Now, keep in mind, opening after COVID, we're 2.5 floors compared to 1 floor previous. So we couldn't use the historical results to try to predict the future, apart from trends and client demands and the like, and interrelationships between different line items within their profit and loss statement. We've come up with what we think is a fairly good estimate of where we're at. But keep in mind, we don't have history. We're coming up with estimates. We're using the client's knowledge and working with the client. So the outcomes, what we're doing is an indicative engagement. So this is our best guess based on the client assistance. We're pretty comfortable where it's coming out at, but we're still trying to predict the future, which, with not knowing, is next week going to have a COVID outbreak and in 3 weeks' time we'll lock down? There's risks involved with that. So it's very important to discuss what essentially the sensitivity of what's going on. That was another thing that sort of came out of a lot of this work, is that the COVID effect, as I said before, is a business interruption in a lot of cases. So it's not like the business disappears. It's just in the short term, they're not getting as much profit, are all making a loss, and it's working out what that reduction in the actual cash flow is to affect the value of the business.
Just got one more here. We've probably got time for one more. How do you account for stimulus payments received by the business? Yeah, I suppose they're obviously not going to be ongoing. So the whole thing with evaluation is, what's the future maintainable earnings? So obviously those stimulus type payments are not going to factor into the future. So really, you've got to take them back out, and also book back in any sales that might have been lost in the short term, but you expect to happen in the future. And potentially the wages bill was down a bit too, because some places might have put everyone back to 4 days, for example, when they thought things were going to quieten down a lot. So maybe for March, April, May, the wages, when you look and drill down into those monthly profit and loss statements, you can see the wages are down, and that's not what's going to happen maintainable into the future. So the same with the JobKeeper payments and things like that, they're not going to happen in the future. So in terms of trying to do the valuation and what does the future hold, you basically back them out totally.
Mm-hmm. Keeping in mind, a lot of this, it's about cash flow. It's not necessarily all about profit. In valuing the business, we need to derive a profit, but it's more about what the cash flows are doing. What's core, what's not core, what's recurring, what's not recurring. And considering what changes had to happen during COVID, but also considering what changes are going to actually remain in place. A lot of businesses have changed how they do business moving forward, how they structure their business, and those things need to be considered.
And I think the other thing that, it's sort of, as a result of COVID, Australia's officially in a recession. So that's, we're back to where we were 10 years ago and post-GFC type thing in terms of, well, how is that going to affect a business too? Is this a business that's a lot of discretionary spending is what drives it? And then in terms of you've got 10% unemployment, is that going to cause people, and I saw something in the paper the other day, the amount of money that Australians have just socked away because they're just becoming more cautious, and discretionary spending has been cut back quite substantially. Now, over time, I suppose, depending on the industry the business is in, you have to make a call as to whether you think, okay, we'll come out of recession in 12 months. What are the economic forecasts? So again, maybe for the next year or so, things won't look too good, but then it'll come back again. It's the same. These sort of things happen in business valuations all the time. You might be dealing with a few years ago something in the mining industry, and you had to make a judgment call on how long is the boom going to last and how long are the good times going to last. There's not too many businesses we see anymore that just roll over year by year by year. Things like medical practices and things like that do, but a lot of businesses have quite lumpy profitability and cash flows anyway, and COVID's just one more factor to take into account, and the longer term effects of COVID on the economy is just something else. From a practical point of view, John and I, previously we would have used a capitalisation rate of 25%. We're probably being a little bit more conservative now, maybe using 26 or 27, and just that'll have the effect of decreasing the value of the business ever so slightly. We're just a little bit more pessimistic, I suppose, as a result of all this.
Yeah, and we're trying to, sorry, Peter, we're just trying to actually quantify in that adjustment we're putting through. We're doing a sense, so there's a lot more work, obviously, but we're putting a sensitivity in the background. If we had a reduction in sales by 5% or 10% as a result of some ongoing effect from COVID, what effect would that have on the profit? So we're actually trying to quantify changes to the profitability, and therefore using that to actually adjust our capitalisation rate. So there's different things we're looking at.
Sorry, I'll just finish. We've got 1 minute left. I've just got one last question. If you're adjusting for JobKeeper, you would also need to adjust for wages that wouldn't have been paid if not for JobKeeper, wouldn't you? Yeah, that's correct. That's exactly right. Yeah, as I said, if you've wound staff back to 3 days a week or 4 days a week, it used to be 5, and you expect them to go back to 5 days a week in the longer term, in terms of determining your future maintainable earnings, you exclude JobKeeper as an income item, and you bump the wages expense back up to the 5 days a week, whatever it costs to have everyone there for that time. So it's 12:30. We said we'd be finished in half an hour. So thanks very much for the questions we did get for those. I hope today's been of some interest to you. I suppose that in a snapshot, what we're saying is, how has COVID affected business valuations? As with any valuation, each one is individual. You've got to look at each individual business. Don't go in with any preconceived ideas about that particular business. But in terms of us from a day-to-day practical point of view of doing the work, certainly we're doing more detailed analysis than we have in the past, and just looking at what the last 6 months has really done to this business, and then considered what's going to happen to it in the future.
Mm-hmm.
So thanks very much, everyone, for joining us, and
good luck on the races.
Yeah, oh yeah, I would almost forgotten. Yeah, good luck on the races for those who are watching. Thanks very much.
All the best.